All right, Karla, let's take a question from the Karla box. All right, this one's coming in from a taxpayer that says, hey, Karla, thinking about exiting in my business. What is the best approach to exit my company without paying the highest taxes?
Oh, that's a really good question. So this person is thinking about selling their business and they're thinking about the exit strategy to get out of their business. Well, here's the thing. When a person is thinking about selling their business, they really got to decide from a different perspective whether they're doing an asset sale or whether they're doing a stock sale. And that's really going to be predicated upon what type of business they're in. Most businesses are selling out of a corporation. They're doing a stock sale, which is advantageous to the seller. Here's the thing that you got to think about. What's the difference between an asset sale versus a stock sale? I think that's so important for people to understand. An asset sale is where you're literally are selling the assets in your business. You're selling your trucks, you're selling your equipment, you're selling things that are in your business that help to operate that business. That type of sale is advantageous to the buyer, not really the seller. The seller actually needs to do a stock sale. They have to be in the right entity to do a stock sale because you have to be in an entity that issues stock, an S corporation or C corporation, and preferably a C corporation, but I'm gonna come back to why I said preferably a C corporation. The reason why you wanna be in an entity that actually issues stock is because in order to sell stock, you gotta have stock. And the only two entities that do that are, of course, the S corporation, the C corporation. I don't think people think about that when they're selling their businesses. Some of them are sitting in LLCs. You can sell an LLC, but really you should convert before you sell. When you're in a C corporation and you're selling your stock in a C corporation, there's a tax code that would allow you to sell some of that stock tax-free, as long as you've held it for at least 5 years. And I don't think that business owners know that. That's why planning around the sale of a business is crucial to keeping the cash in their pocket.
So when it comes to selling your business, you said there's a difference between an asset sale and a stock sale. Can you explain that again?
Yeah, so when you're selling your business, you're either selling the entire business, meaning you're selling the stock, you're selling the equity. I'm selling my whole business. So let's say I have 123 Main Street. I'm selling 123 Main Street directly to you. So you're taking the entire business, the entity, 100% of everything. And an asset sale, I may come into your business and say you have a trucking business that also has storage attached to it. I may only be picking up the assets, the trucks out of the business, and I'm only taking those things from the business that are being sold. You will indeed keep the actual business, the entity, everything else associated with it.
Is that kind of like what McDonald's did, where people can start their own franchises and buy the assets of a McDonald's, but still McDonald's owns?
It's a little bit different than that. When you are purchasing a McDonald's, you really are not technically purchasing assets. You're really purchasing the rights to use their name. That's really different. However, when you own a McDonald's has a lot of equipment, tons of equipment, the fryers, the freezers, things like that. So if you're purchasing a McDonald's, you're gonna buy assets in that purchase, and McDonald's is actually allowing you to utilize their business name. So it's kind of a little bit different.
Got it. So if someone's going to buy into a McDonald's franchise, would they have ownership of the property itself too, or just the business and the income that's being made?
They only gonna have absolute ownership of the business and the income being made. McDonald's is in the real estate business, and McDonald's is not giving up its land. They're only selling you their model. A lot of people think that McDonald's sell hamburgers, but McDonald's real model is they own real estate. The franchisees that own the McDonald's, they're just getting the business model. They're not getting the real estate attached to it.
Okay, so when you said it's important to sell your company, you want to make sure that you're choosing the right entity, and that could require you having stock, and we know that stock's associated with S Corps and C Corps. But what if you're starting a franchise?
Yep.
And you're thinking about selling a franchise? Would a franchise be underneath a corporation, or would it make more sense to have that under LLCs or series LLCs? Or how would you do that?
That's a really good question. Most times when you're purchasing a franchise, the franchise agreement is going to require you to be in a corporation. They have special requirements based on your franchise agreement. Most franchisees that we deal with, McDonald's, Subways, they're typically in S Corps, they're typically in C Corporation. Very rare are you gonna see, and I've never seen in all the years I've been in practice, a franchise is in an actual LLC. They want the issuance of stock. They want the formal entity. They want the ownership to really be in a more of a formal fashion versus like being in a traditional like LLC, sole proprietorship. They're not going to allow that.
Okay. Now, what if you decide, instead of like buying into someone's franchise, like buying my own Chick-fil-A, buying my own Crunch Fitness, you decide to start your own franchise, right?
Yep.
Like Karla's Tax and Accounting, and then you want to open up more Karla's Tax and Accounting. Would it make sense to run that as a corporation and have one corporation all flowing, or should you have multiple corporations, or would it make more sense to have multiple LLCs?
That's a really good question. Okay, so if I'm owning Karla Jensen Associates Inc. and now I want a franchise where I'm gonna have other people come in, those people need to have their own entity. But if I'm gonna open up multiple businesses that I'm going to own, I am going to have those businesses be in an additional corporation. So I'm gonna have a holding company, and then I'm gonna have sub companies underneath it. So there's a parent company, and all the subsidiaries are going to be those additional companies.
Okay. So when I hear about additional companies, the first, or even when I hear taxpayers thinking about additional companies, the first thing that comes to their head is, oh my gosh, this is going to be so many different filing fees. I'm going to have tax returns for like 50 different LLCs if I want to start all these different things. Is there a way in which you can group them into like one tax return, or is there a way in which you can avoid having to set up entities across like 50 different states with all these different names?
Yeah, there are ways to avoid it, but chances are you're not going to want to avoid it. Because if you're going to do business in multiple states, you want to have an entity open in that state, because those states require, if you have physical property in that state, if you're generating income in that state, the states are going to require you to register with that particular state. So you're not going to get out of having multiple entities. I know people think that. We hear all the time, oh, I'm going to open in a non-taxable state. I'm in Nevada, I'm going to open up my business there, but I'm actually doing business in California. California is going to require them at some point to register in California. They're supposed to do it at the very onset. Maybe they haven't gotten caught yet, but it's going to come, especially if you have employees, you're registering trucks, registering equipment. Eventually it's going to come through the back door where you need to have that entity there. One thing that business owners can do, you can have a corporation, and a corporation can own an LLC. So within that corporation, you can have smaller LLCs that can be like subsidiaries and stuff like that. But at the end of the day, for every state that you're operating in, you need to have an entity in that state. You need to be registered in that state. If you're going to have employees, if you're going to have property, if you're even going to come through that state for any reason, states want their money.
What is your viewpoint on like establishing management companies? Because I know we get asked all the time, okay, when does it make sense for me to have a business managing my business? What do you think is like the income level or the entry or barrier to entry for someone to start considering a management company for their operational company?
Yeah, so we do get that a lot, right? I think that what people need to realize, once you have one business and you decide you're going to branch off into another business, those businesses are going to get the result of you as the individual, all of your knowledge. That's where you need to get a management company. You need to get a management company where your taxes start to increase, because you can then create an off-year entity to lower your income taxes. I just think as you grow as a business owner, you got to get out of that mindset of worrying about creating extra entities. Oh my gosh, it's going to be so much paperwork. Well, it's going to be a lot of money too, right? Because you now starting to make more money. So I look at entities as an insurance policy against being sued, making sure that I put separate income in separate entities. And that's really important for all sorts of reasons. Tax being one, making money being one, lawsuits being one. It's just the nature of the beast. That's why big companies have multiple companies underneath that.
Yeah. Speaking of nature of the beast, the tax code is quite a beast. And if there's anybody that understands that there's levels to this, it's me and you. You are definitely on a different level when it comes to this whole tax game. One of the things that I notice about taxpayers who come into our office is sometimes they've been educated or coached on establishing all these different corporate entity structures, a Nevada entity that owns this, that owns that. And I have, sometimes even elderly women who may only have one rental property have trusts and multiple corporations set up. So What is someone supposed to do as a taxpayer who's trying to establish the right asset protection, trying to establish the right entity structures? How do they know when they should be establishing things? How do they know not to get sold into something that they may not need?
Yeah, it happens all the time where people go out to these different events, they come back, they have one business, they come back with 10 entities, right? We see it quite a bit. I will say to anybody, here's some rules of the game that you need to follow. Number one, your business needs to be set up in the state that you're doing business in. If I'm doing business in multiple states and I have a nexus, employees, I have property there, I have a physical location, an address, then I need to set up a business at that particular location. Outside of that, set your business up in your domicile state where your business is physically located. As your business grows, as you get different revenue models, you can then branch off and start to create other businesses. But there needs to be a reason. All of this layering of 50,000 entities talking about asset protection and I'm getting sued, and if I'm here, they're not going to ever find me. I've been doing this for a very long time, and I'm going to tell you that our really rich clients, they don't do that. Yeah. They're not setting up all these different entities. They're not hiding in Wyoming. They're not hiding in Nevada. They are not doing that type of stuff. They're running reputable businesses and the state in which they're operating their business in, and they're doing quite well. And they're managing their taxes through planning. Mm-hmm. That's how they're doing it. And because they have good governance, they're doing the proper thing with their business. They're doing what's right. They're not worried about lawsuits. Mm-hmm. They're not worried about those things because they know their house is in order. And that's the key, really, is make sure your house is in order.